Good morning, good afternoon. Welcome to Now Innovation, Productivity and Challenge in Digital Era, Asia and beyond. And today we are very great to have Alberto ROSSI from Georgetown University to present his joint work with Francesco and Michael Weber in terms of the title Crowdsourcing Peer Information to Change Spending Behavior. So Alberto is a well-known scholar in the fintech and enterprise in machine learning. Currently, he's a professor of finance at Georgetown University, and as well as director of AI and analytical and future work initiative, plus RUAN academic fellow. And welcome, Alberto. And also today, we're also very glad to have our distinguished friend and the scholar, Tianyue RUAN from NUS as a discussant. And today's whole format are following. Alberto will present the first 25 minutes, and Tianyue will discuss another 25 minutes, then a 20-minute discussion. So floor is yours, Alberto. Welcome. Thank you.
Thank you for the invitation to come and present. This work is titled Crowdsourcing Peer Information to Change Spending Behavior, and it's a joint work with Francesco from Georgetown University and Michael Weber from the University of Chicago. And before getting into the actual paper, let me just give you a couple of words or tell you a little bit about this research agenda on robo-advising that my co-authors, my collaborators, and I have. I mean, the starting point, I think, is that there is this very strong common perception, at least within practitioners and also within academia, that robo-advising comprises automated advices for portfolio allocation. So whenever I mention robo-advice, people immediately think about Betterment, Vanguard, Jiaobao, for example, in China, Personal Capital. So all those tools that help individuals make better portfolio allocation. But if you think about it, households' decisions are way more complex. Individuals have to decide what kind of mortgages to take, what kind of credit cards to pick, what kind of car payments to embark on. And then they have to decide on the asset side, what kind of housing or cars or other durable assets they would like to spend their money on. So if you really think about the households as a firm, you can think of them having assets and liabilities. And so you can really think about robo-advising as automated advice for any household choice. And this is exactly the direction that the research agenda of mine and my collaborators have. So if you're interested in these topics, what I would recommend is definitely, if you're interested in robo-advising for investment decisions, we have a number of papers that initially started with establishing some facts about robo-advising and now are getting deeper into questions that are related to algorithmic aversions, for example, like what are the mechanisms or forces that prevent individuals from following robo-advice and how can you counter them? But we also have this very strong kind of research agenda on trying to understand how robo-advising and fintech can help individuals making better consumption, saving, debt, and lending decisions. So along these lines, for example, I have a paper with Antonio Gargano on trying to help individuals making better saving decisions using fintech, and with Francesco and co-authors and Pulak, for example, Pulak Ghosh, we have papers trying to kind of stress how robo-advising can be helpful in peer-to-peer lending decisions, for example, and also how robo-advising can help individuals better manage their debt using automation. But today we're going to be focusing on this paper titled Crowdsourcing Peer Information to Change Spending Behavior. And the way I really wanted to interpret all the work that I have is like, I wanted to think of this as a kind of robo-advisor for individuals in helping them making better consumption decision. Now, the motivation for this work is that very simply, like the low savings is really kind of one of the strongest causes for the limited wealth accumulation for retirement that we see in American households. And one of the main reasons is that households have very little information about what is their optimal saving rate. Even as economists, it is actually quite hard to compute the optimal saving rate. And so what we do know is that individuals are likely to acquire information on how much they should spend by looking at others. And this kind of raises the potential role for the visibility visibility bias that was raised and was kind of introduced by Han Hirschleifer and Walden in 2018. The idea is very simple. Suppose that I'm kind of basing my inference on other spending choices by just looking at them, but I don't see their entirety or their consumption. I only see their most conspicuous part. Then I may end up overestimating how much people are spending, and this may be particularly a strong bias in times of social media. Just to give you a sense of what I'm talking about, and also to take an opportunity to make fun of a collaborator of mine. If you were to look at Michael's Instagram account, you would see him maybe sipping champagne, but what you would not see are the daily grind where he works on his research, and maybe he spends his nights eating a bratwurst and lettuce, trying to kind of get into the next R&R and publish the next paper. So in a context where biased inference can lead to severe overconsumption, a natural question becomes, how can we save, or how can we help individuals? In principle, what we would need to do is to provide individuals with their overall spending of the other. So the entire complete picture of how other people spend in their daily life. And of course, this is extremely difficult to do with traditional tools, but this is something that we can easily do with fintech. So what we're going to be doing in this paper is we teamed up with a income aggregator application called Status. You can really think of this as a robo-advisor for consumption. What the tool does is it provides income aggregation services, and I'll be more specific in a minute what I mean by this. And but very importantly, it gives individuals information about their peer spending. So the habits of people that are similar to them. So what we're going to be doing in this paper is trying to understand how whether individuals react to this information, and if yes, how they do it. And as a side product, this is actually going to be a very nice and clean setting for us to try and understand how peer effects can affect individuals' decisions in a context when we can rule out by construction common shocks and socialization, which are usually one of the biggest confounding factors in most of the work that deals with peer effects. And just to give you a sense of the main results we're going to have, let me just summarize in a picture some of the results I'm going to show you over the rest of the presentation. What I have here is a bin scatter plot, and on the x-axis I have something called distance from peers. What I'm doing here is I'm putting all the individuals that are spending more than their peers to the right of the zero line. So all those people that are consuming in excess of people that are similar to them before starting using the app are going to be on the right. And on the left-hand side, I'm going to have the ones that are kind of spending less than their peer before adopting the app. And this is, you can see 0, 1, and 2, just because this is standardized so that it's in standard deviation units. And then on the y-axis, I have instead how much people change their spending after and before signing up for the tool. So the way you read this plot is as follows. Those people that are overspending, that spend more than their peers before signing up, they decrease sharply their consumption after signing up for the app. Those people that instead are spending less than their peers, they actually increase their consumption, but they increase it by less. And of course, you can see that the effect tends to be rather monotonic. So there are not very strong nonlinearities. So in the rest of the paper, I'm going to show you these results in a more structured way. I'm also going to show you that individuals are going to react more if the peer information is more informative. I'm going to show you that lower income users are going to be reacting more. And then finally, I'm going to show you that these results that are based on a selected population, so a kind of individuals that decided to sign up for the apps, are actually externally valid. So we're going to have a randomized control trial on a non-selected population showing that the underlying mechanism we highlight in this paper is a kind of universal, also for people that do not choose to sign up for the app we are working with. Now, let me take a step back and give you kind of more details about the app. So if you were to sign up for Status, what you would do is tell the app what your annual income is, which would actually be verified, exposed by the inflows into the account. You would put your age, your home ownership status, your location, and your social security number. And then you would be required to link all your accounts. So your debit accounts, your credit accounts, your retirement and investment accounts. After taking this information, suppose that you were someone that is 42 years of age, makes $140,000 a year, lives in New York City, has a credit score of 769. What the app would do is create peers or peer groups for you. So in this case, for example, it would bucket you with people that are between 40 and 50 years of age, that make between $100,000 and $150,000, and that have a credit score between 720 and 780. And you can see that in this case, you have that the peers are approximately 10,000 people. And keep in mind this income ranges because they're going to become important towards the end of the presentation. But effectively, what the tool is doing is creating the kind of a profile of peers that are similar to you. Just to get a little bit more into the details, for every person, a peer group will be created. The peer groups are created on all the characteristics I mentioned, subject to the constraint that there needs to be at least 5,000 individuals. What is very important is that the spending information that I'm going to be showing you in a second is actually not taken from other status users, but is taken from a random set of individuals that the companies purchased. And so what the app is doing is comparing the client's consumption to that of their peers in a very easy and straightforward and salient fashion. So what do I mean by this? So if you were you were signing up for the app, and suppose you were at the end of the month of October, what in this case, the app is showing you is how much you've consumed. So in this case, the user has spent $18,000 over the month of October. Then the peers over the same month has spent approximately $8,600. The national average, so the average US individual has spent $4,000. And you can also see here the average income of the individual was $10,000 per month. Now, what we're going to be doing is kind of using this information. So those people that are overspending to their peers, we're going to see how much they react, as well as those people that are underspending compared to their peers at the time of sign up. Just to give you a sense of the type of individuals we're dealing with. So we have 21,000 individuals. They are 32 years of age. They have a relatively high credit score, 740. 40% of them are homeowners. They have an annual income of $93,000. They spend approximately $5,000 per month. And if anything, they tend to be pretty conservative. So they tend to spend less than their peers at the time of sign up. And in terms of how they're located, this is kind of a map constructed from the IP addresses. You can see that it replicates very nicely the map of the United States. Now, let me start with showing you some of the results based on the raw data. So what we're going to be doing here is study the change in spending behavior around the sign up. We're going to be working with 3 months prior and 3 months after the sign up. We're going to split individuals into those spending above and below their peers, and we're going to seasonally adjust the spending using time fixed effects, because of course you may have that people are going to spend more in December, for example, compared to January, because they may have extra expenses related to Christmas, for example. So as I was mentioning you before, this is exactly the same plot I had in the motivation slides. Those individuals that were spending more than their peers before signing up, they decrease sharply their consumption. Instead, those people that were under consuming compared to their peers, if anything, they increase their consumption and they react less. So one of the concerns you may have with this plot is that we somewhat arbitrarily set the threshold as 0, right? So it may be that maybe this is kind of an optical illusion, and this is actually not something that the behavior is driven by a different effect and not the peer consumption effect. And so that kind of information may be correlated with the peer information. So what we're going to be doing next is to use this procedure developed by Bruce Hansen in 2000. It's called an endogenous threshold regression. What we're doing here, we're fitting 2 regressions, and we are splitting optimally the kind of the support of the distance from peers in such a way so as to kind of maximize the likelihood of the joint model. And you can see that two things. First of all, the split or the threshold is not statistically different from 0, so it's very close to 0. And also we can actually recover that the two lines or the two coefficient estimates are significantly different from each other. We can also use another procedure, that is the kink regression procedure by Hansen in 2015, where we find this is nothing else but a piecewise linear spline. What we find once again is that the threshold is very, very close to 0, and once again we have that the people are under consuming and over consuming before signing up behave differently when they when they observe this peer information. Now, as a reality check, what we do is to try and understand what is the underlying mechanism. Of course, in principle, you would expect that people will be able to cut their discretionary spending, but not so much their non-discretionary spending. So the people will cut their spending on shopping, for example, or restaurants, but they cannot really change their spending in utilities and other fixed expenses they have. And this is exactly what we find. If we split the consumption into discretionary and non-discretionary spending, we find that the entire reaction comes from the expenses on the discretionary side, and nothing happens on the non-discretionary side. And finally, up to now, I showed you only the results 3 months before and 3 months after signing up. And mainly this is because we want to kind of maintain as large of a sample as we can. But if we kind of move forward and get all the way to 12 months, what we find is that the effect tends to be relatively stable and monotonic, right? So overspenders significantly decrease their spending after signing up for status, and underspenders instead significantly increase it afterwards. And this is something that is kind of uniformly and universally in the data. But of course, there are a number of caveats associated with the raw kind of data results that I just showed. One concern you may have is that, of course, the raw results do not really account for difference in spending level across users. Everything was done in dollar terms. So what you want to do is potentially use something that normalizes their spending compared to income, or the spending before signing up for the tool. So what we're doing here is, and also another concern you may have is that maybe you want to have additional controls because some other variables may be driving this change in spending. And this is exactly what we do in our multivariate settings. The first thing we do is to kind of construct a variable where a different dependent variable we have is just the normalized ratio of the spending post and before signing up for the tool. And this, you can see that the results are pretty much the same. For those that were overspending, they systematically reduce their spending. Those that are instead underspending increase their spending. And if we run a regression where the distance from peers is on the right-hand side, we find once again exactly consistent results. And the results are robust to adding additional controls. But you may have some other concern. For example, one concern that was worrying us was that of mean reversion. So what may happen is that those individuals that end up being overspenders are simply overspenders because at the time of sign up, so the month before signing up, maybe they had very large expenses. Maybe they bought a computer, they bought a phone or something else. And so what we do is directly control for pre-sign up spending. And also we use we determine overspending not using this month at the month before signing up, but also 2 months and 3 months before signing up. And in all the cases, we find exactly consistent results, that the effect of peer information is always consistently, significantly there. Another concern we may have is that of the typical identification concern, right? So you may think that those individuals that sign up for status know that they are overspending or underspending at the time of sign up. So they may have changed their spending no matter what. So even if they didn't sign up for status, they may have changed their spending. Apologies. So we're going to be doing this is actually something very interesting. So we're going to be having an identification strategy that exploit the cutoffs that are used to assign users to peer groups. If you remember from the plot I had at the beginning, what I was showing you is that the app constructs or categorizes or creates peer groups using buckets. And the most important buckets are the income buckets. These are going to be the 35,000, 50,000, 75,000, 100,000, and 150,000 cutoffs. Now, the interesting things, of course, is that if you were someone that was reporting a $49,000 income, you would be matched to a peer group that has an income between 35 and 50. If instead you reported 51, you'll be matched with someone that with a peer group that instead comprises people that make between 50 and 75. So all this to say is that if you are kind of making an income that is just above the cutoff, you would be matched with peer groups that have higher spending. Instead, if you were kind of had your income was just below the cutoff, you would be matched with peer groups that have lower spending. Now, then we're going to be using exactly this discontinuities in our identification strategy. So the first thing we need to do is to show that there are no detectable differences in pre-spending around the threshold. So we do this for spending. For example, here I have the $50,000 threshold. You see that there is no really difference in consumption below and above. And then in the paper, we're much more thorough and we do the same exercise for home ownership, log of credit score, log of age, asset balance, debt balance, so all the observable characteristics we see in the data. Then we only keep those clients that are close to the threshold. And because of the bunching that we observe at some even numbers, we need to have an asymmetric bandwidth, but we also show that the results are the same with symmetric bandwidth. And then we're going to be using the random assignment to instrument for peer spending. In kind of in layman terms, what we're going to be doing is using a two-stage least square specification. On the first step, we're going to instrument peer spending using the spending before and above dummy regressor. And on the second stage, we're going to kind of regress the change in spending on the instrumented peer spending. And the idea is that we expect this beta coefficient to be positive and significant. And this is exactly what we find. We find that in the first stage, this above dummy coefficient is very strongly positive and statistically significant. And in the second stage, the peer spending coefficient is positive and significant, which is basically nothing else to say is that if you are randomly assigned a higher peer spending, you're going to be spending more, and vice versa. If you have assigned with a lower peer spending, you're going to be spending less. Now, one concern that you may have, and this is related to the fact that some of the kind of we have some bunching at kind of even numbers. You may think that maybe some of these results are purely driven by the fact that something different happens for those people that claim to have 50,000 or 100,000 or 150,000 in income. So what we do is we kind of repeat the procedure using a placebo IV specification, where we have thresholds that are similar in nature. So we have even numbers, but they are slightly kind of different from the true thresholds. And when we repeat the procedure with this placebo IV, we find exactly the typical sign of a weak instrument issue. We find that in the first stage, the above dummy is not significant. In the second stage, the coefficient of peer spending blows up, becomes very large, but it's also insignificant. Now, I don't have time to show you all the results we have, but in the heterogeneity results, we show that the reaction is different or is stronger as a function of signal informativeness. So we find that the user react more to more informative signals. So people react more when peer groups comprise people that are more similar to them. They react more if the number of people in the peer group is larger, and if the peer group's income width is smaller. So if the income of the people in their peer group is closer to them. And also, finally, we find that the results are stronger for those people that are unlikely to have access to peer information before using the app. An interesting kind of heterogeneity exercise relates to those that have low income. So in principle, the effect for low income households is unclear exactly, right? So we know on the one hand that low income households may have less access to information regarding other peers' spending. But at the same time, we know that there is a larger part of low-income household spending is not discretionary. And so it's not really clear which direction the heterogeneity may go. And if we actually kind of put the data to the test, what we're going to be doing here, I'm going to show you this change in spending normalized by income across different income levels. So the income group number one comprises people that have the lowest income, the lowest quartile of income. Income number 2, 3, and 4 become progressively progressively wealthier. So what you see is that, if anything, the higher the income, the lower the reaction to this peer group information. Finally, while I once again I don't have time to kind of show you all the robustness tab, we have in the paper a ton of robustness checks where we show that the results remain the same if we limit the sample to users with more than 2 accounts linked, individuals that have less than 35 years of age, individuals that have income below $200,000, and if we use a variety of filters based on the spending and login activity. We show also that individuals are really reacting to peer info and not to other information that is shown on the app, such as the spending of the average American or their income level. We also show that the results are robust to alternative regression specifications, and they are robust to using different kind of ways to construct standard errors to conduct a statistical inference. And finally, if we have different bandwidth for the IV strategy. Now, given that I have only 1 minute left, I want to spend it on talking about the problem of external validity. So far, I showed you that all the results are kind of consistent and very strong, but they are confined within a specific population. This population is the population that decided to sign up for status. So these may be people that care more about their finances than the average individuals. They may care more about their peers' finances more than the average individual. So the natural question you may have is whether these results are going to be externally valid. And so what we did, we designed this exactly same intervention on a kind of non-selected population, and we did this on a study kind of on the mechanical Turk, Amazon Mechanical Turk. What we did is a randomized controlled trial where we told individuals, we asked individuals how they would change or how they would spend a windfall, so like a positive sum of money that would fall from the sky. And then we show how people similar to them would react. And then we asked them again how they would change their responses. What you see is that even in the context of individuals changing and observing other people's marginal propensity to consume, you can see that those people that were spending more than their peers, they decrease their marginal propensity to consume after observing that of their peers. So they instead had a lower marginal propensity to consume of their peers. If anything, they increase it. And so we also show that the results are robust to conditioning on demographic characteristics that we do not observe on status. So we are very confident that this effect may actually be something that is broadly deployable on the broader population and not only on a selected sample of individuals that decide to sign up for these kind of apps. So given that I'm out of time, let me take a couple of seconds to conclude. We showed that users that spend more than their peers reduce their spending significantly, while those that spend less than their peers keep constant or increase their spending. We find that the peer information signal is very important in the kind of determining in that kind of more informative signal leads to stronger reaction. And of course, one caveat that I want to leave you with is that this is not this is unlikely to be an optimal way to recommend individuals how to make a consumption decision, but we want to highlight the importance of the channel. And we want to make sure that this tool or this kind of mechanism could be incorporated in robo-advisors for consumption decisions going forward. But thank you so much for listening, and I'm looking forward to the discussion by Tianyue. Thank you.
Thank you. So Tianyue, it's your turn. Thank you. Can you upload your slide?
Thank you very much for inviting me to discuss this very interesting paper. So let me just summarize very briefly what the paper do. So the paper asks the very interesting research question: do consumer spending respond to the revelation of information about their peers' spending? So what is different from many other peer effects papers is that in this paper, the peers are actually anonymous, not your personal contact. So the setting is in a financial aggregator app with also information about peers that allow peer comparison. So when users sign up for the app, they are paired with a group of anonymous peers that are demographically similar, so such as having similar income, similar credit score, so on and so forth. After that, the users will be able to see their own real-time spending that is collected through their own accounts linked to this aggregator app, as well as the peer spending, which I understand is retrieved in a past time. So the main finding is very cool. So even though the consumers do not know these peers, they still respond to this newly revealed information about peer spending. So they adjust their spending by converging to the peer level, and the finding is asymmetric. Those who spent more than their anonymous peers responded more strongly than those who spent less than their peers. And I also, applaud the authors by going out of their way to establish external validity through a different RCT on a completely different sample, which I think, just further strengthen the credibility of the results. So this is the anonymous peer, which is taken from the paper. So I think Alberto shows the same figure in the presentation. I think what is interesting is that although you don't know the peers, but if I see these information comparison, I would tend to agree that these are the relevant peers because similar age, so similar life cycle, perhaps similar income and similar credit score and similar home ownership type. So this is the anonymous peers these app pairs you with, and the effect, which I think is very visible even in the raw data plot. So those who spend more than their anonymous peers, they cut their spending aggressively, so the slope here is very negative. Those who spend less than their peers, their spending response was much more muted. So this is, I think, one of the very cool finding of asymmetric convergence. So for this discussion, first I want to say that this is a fantastic paper. I enjoy reading. So I think because of the construction of the anonymous peers, it's a very clean setting to separate from the classic confounding factors such as common shocks. And the empirical execution is impeccable. And also, I like this asymmetric convergence a lot. I think this is a very interesting finding. So for the discussion, I would want to first talk about, what I think are implications for big data and household decision making. So I concur with Alberto's point that robo-advisor can actually, influence decisions, not just in investment, but other dimensions of household decision making. And then I would offer 3 comments on ideas. So let me first talk about the first part, which is the big picture implications in my own opinion. So we all know that, social interactions shape different domains of our decision making. So individuals, it's quite intuitive to every individual to consult with who they know, their social networks, on a lot of different decisions. from consumption decisions such as which phone I should buy next. Okay, is the new iPhone good or not? To where should I shop for grocery good? To financial decisions such as which bank should I use? How much should I pay for the house? Okay, is if I'm thinking about real estate investment, so many people would want to ask, okay, is it a good neighborhood for their kids? So what kind of mortgage should I take? Stocks, which kind of stocks I should invest, and which broker should I use? So these are the decisions people typically consult with their social network. I think big data greatly expand who are these potential peers you can consult with and get valuable information. So for instance, this app used in this paper is called Status. It basically allows you to compare finances with peers you don't yet to know, but whose information is valuable for your own decision making. So I think this, although Alberto is very careful about welfare implications, I do think that the capabilities offered through such app can be beneficial to individual well-being. On the other hand, okay, there are some other examples about such anonymous peers or coordination among retail investors can actually disrupt things. Okay, for instance, this is a classic example of the Reddit forum of Wall Street Bets, where retail investors who don't know each other, they somehow can coordinate in this platform, and then make disruptive investments in those meme stocks. Okay, so this is another example of technologies changes who our peers are. So most people would like to think that if it's like a Wall Street Bets, it may not be social welfare enhancing. Although this is a very active area of research, but I think this is how technology has been changing the landscape. So given with this in mind, okay, technologies can change who are our peers. I would like to move to my first comment, which is what is the mechanism of peer effects for this specific setting of consumption? So peer effects can take place in many different forms. Okay, here I borrow from the summaries from this review article by Kukler and Strober. So they summarize peer effects of having three different mechanisms. The first one is what they call social learning. So this is concerning the spread of information, sentiments, and beliefs through peers. So what we know is that actual information is valuable for good decision making, but quite often information is not that easy to access. So people typically would consult who they know, such as friends, colleagues, mentors, to gather this information. But I think what this paper offers another angle is that it can also be from peers that you don't know. And this is enabled by the big data technology. Okay, so this is social learning, which I think is a relevant aspect for consumption decisions. The second aspect is social perception or social pressure. So basically, the idea is that social networks, they facilitate enforcement of norms, rules, and agreements. So such as through approaches such as social shaming, stigma, and threats of ostracizing. So I think this mechanism is unlikely to operate in a current setting, which is another reason why the identification is quite clean in this setting. And third aspect is that peers' action can directly enter individuals' utility functions. So this is called social utility, okay, according to this review article. So the idea here is that there can be social comparison for mechanisms such as keeping up with the Joneses or fear of missing out. So I think the question is that for the current setting, can this mechanism play a role? So when I think about this myself, I think actually this mechanism is quite likely to play a role. For instance, then let's first talk about the first aspect, which is learning. So if I think about, what kind of information from peers would be valuable for decision making, I personally think the following features, okay, correspond to information being valuable. The first one is that if it's a decision that is very, very high stake and very infrequent, okay, I personally may not have enough information, so I want to seek out information from other people. Or if the issue at hand is difficult to understand, such as many financial decisions, okay, I would want to, collect information by talking to my peers, okay. And the third aspect is that if soft or context-specific information is needed, okay, then information and social learning from peers will be valuable. And lastly, okay, is that these other information sources, such as brokers or bankers, or even social media or friends, okay, may have biases or conflict of interest. So if I think about what kind of information is provided in this setting, the information signal is about the level of consumption by my peers, which is the dollar amount. I do not think this is quite what I would call high stake or infrequent decisions, because most of the consumption here are day-to-day consumption, discretionary or non-discretionary. I make the consumption decision quite frequent, so it's not something that is high frequent, okay? And second, I do not think there's a barrier of high sophistication, okay, because the level of spending, okay, this notion is well understood, okay, by even people with modest financial sophistication. And thirdly, this is just the level of consumption, so it doesn't provide much soft or context-specific information. So when I see the dollar amount of my peers spending, actually I do not know, what's in their consumption basket. So I think this also, rules out soft and context information being provided here. And I think that, this dollar spending amount can be more accurate than other information sources, such as social media of my friends' spending profile, because those social media, as Alberto pointed out, may feature or visible or conspicuous consumption much more. So overall, I do think that the information about peers' level of consumption provides, is valuable, but I think the learning channel is probably not as compelling for this particular setting than to, some other settings such as housing choice, mortgage, and investment, where, high stake, infrequent, and financial sophistication features, are more important. So having said that, so let's turn to the other theory, which is social utility. If I think about this, actually, I think the channel is pretty clear, because, this is also related to the habit model in asset pricing that is one of the workhorse asset pricing models. So, from the earlier, theoretical framework in this literature is that individuals may have preferences over relative differences between their own consumption and consumption of peers, okay? In the external habit models, habit is also determined by the aggregate consumption. So I think, from these classic models, there's actually we don't need socialization or social pressure for these social utility channel to play a role. So if I want to map out the findings of this paper to this literature on social utility, I think the results in this paper suggest a more nuanced, relevant comparison groups in social utility, because these earlier models, I think they focus on, aggregate consumption in a representative agent setting. But we know that, using the microdata, there's a large amount of heterogeneity we can use. And the authors show that they react to their own peers peer groups spending, but not the average US population's average spending. So I think this can suggest that in a social utility framework, actually it's the closest peers that is most relevant for your comparison. Okay, so I think this is what I think about the mechanisms. So I think it will be very I think it will help me to further see these papers. So if the authors can speak a little bit about these two mechanisms. So the second point I want to make is make a suggestion that basically changes the emphasis from consumption to savings. This can be an addition to what the authors already have. So I think comparing the savings rate with peers can speak closely to the low savings phenomenon used in the motivation. So, savings, which is income minus spending in the most basic form, that's how, wealth is accumulated. And I believe the data can actually provide a very accurate analysis on this front, because the transaction data can enable accurate measure and timely measure of income, spending, and savings for the app users. For the peer groups, when I read a paper, I don't think their real-time income, but or the individual level income, but I think you can still calculate an approximate savings rate, which is the difference between the average income in that bracket and average consumption. I would expect the above and below peer spenders, which you currently focus on, correspond to below and above peer savers. So those who spend more than their peers, they should save less than their peers. I think this should be mapped out, but it would be very useful if we can see more directly in the data. And continuing on this dimension of savings, okay. So I think it's interesting to know whether and how households would adjust savings towards their peer group. There's these classic papers that show that individuals actually decrease their retirement saving contribution when they are given information about their peers contributing, and they attribute these perhaps surprising negative effect to this discouragement from upward social comparisons or social pressure type of story. So in this setting, using the financial aggregator app, I think, okay, since we have convergence of consumption, okay, we should also have convergence to savings to the peer level, okay. So which is opposite to this existing finding, and I think it's interesting to know, okay. And and also, if let's say we do find a convergence of savings, which is encouraging if we want to think of a solution to encourage more saving, I think it will be interesting to know how do households make these adjustments. Do they respond in their financial market participation? Do they change their investment behavior, so on and so forth? So lastly, so this is a relative minor comments on the measurement side. So when I read the paper, I noticed that about 3/4 of the users, they have below peer spending, and 1/4 are above peer. So it's not quite balanced. So I keep wondering why this is the case. So one conjecture that I have is that maybe the measurement months for the peers, okay, coincides with a high spending month such as holiday season. So since the peers spending is static, right? I don't think a seasonal adjustment may necessarily correct for this. So I wonder whether users whose spending at sign up covers the same high spending months, are they more balanced? So do we have more balance above and below spendings if you look at this segment? And the second aspect is that I find some of the magnitudes in the paper a little bit difficult to interpret. So for instance, the average spending in the past 90 days is close to $5,000 US. So above peer spenders, they on average spend $4,000 more than their peers. And those who are below peer, they spend about $4,400 less than their peers. So these magnitudes are actually very large compared to the average spending of the app users. So I think these gaps are not very straightforward to interpret. So I wonder whether these are driven by outliers or they are just driven by the heterogeneity of the baseline spending levels of these two above and below peer groups. So, and lastly, I wonder whether users with small versus large differences from peers, they respond differently. Because if I think about consumption adjustments, there might be some cost involved. Otherwise, people may have already changed the consumption even before signing up for the app. So if adjustment is costly, we naturally would expect that only users with substantial differences would adjust their spending, okay? So this is my last comment. So lastly, I want to, just talk a little bit about the policy implication. So as I already mentioned, technologies changes who are our peers in the domain of finance. And I like this research agenda of robo-advising for household decision-making a lot. So this technology-enabled solutions indeed can facilitate a lot of household financial planning. So provision of targeted peer information, what is these people do, can influence behaviors. So I think this is a useful tool to have if you want to think more about, how do we improve financial well-being? How do we use this to improve welfare? And lastly, I like this use of anonymous peers a lot because people typically worry that, there may be a compromise between data privacy and transparency. Because sometimes if you provide too much data or a lot of data, people might be worried that some vulnerable groups' privacy is exploited. So I think that this creation and use of anonymous peers can preserve privacy and allows for aggregate statistics to be computed of, in a similar spirit of these Avid, Kandagi, and Low papers. So lastly, I want to show you this and then just conclude my discussion. So this is a financial aggregator app that is currently promoted by the Singapore government. So I think the idea is similar to the app that Alberto is studying. So we want to link the different accounts so that people can have a comprehensive view of his or her own finances. And to make better financial decisions, when I sign up for this, government initiative of financial aggregator app, I noticed that there's no such functionality as peer comparison. But personally, as a user, I would like to see some peer comparison that is using anonymous data, so nobody's privacy is infringed. So, and after reading Alberto's paper, I think I confirm my prior that peer comparison, peer information is valuable for at least my personal decision making. So I think this idea is getting traction. So maybe if you want, I think Alberto, you can also talk to the Singapore authorities to implement some of these solutions and ideas. Okay, so this is all I have for the discussion. Thank you very much for listening to me.
Now we move to the discussion section. So any questions from the floor or online? Yes, I think Professor Xu. Please go ahead. Unmute, please. Yeah, Bonnie, please unmute.
You want me to unmute or you want, is this portion going first or me?
Doesn't matter, go ahead, please.
Oh, okay, thank you. Several things. First, Michael apologized for not being able to turn up because Michael Zhong, he caught COVID and is having a high fever, so he couldn't make it today. Apologies from him. Okay, I have a few questions. This is fascinating and it's really, really interesting. I have a few questions, so bear with me. Number one, I'm curious, who developed the app and for what purpose? Who signed up for the app and for what purpose? Is there any unique distribution across income groups and also across geographic regions that we can detect? Would there be variations that show us some information about the signing up of the app? Then the second thing is that when we think about this, human beings are always looking towards the center. Like, I'm an old person. I check my blood pressure all the time, but I check my blood pressure and benchmark it against the average blood pressure of my age group and use that to monitor my behavior. I mean, this is just what human beings do. So I think it is natural for us to expect that when we see the peer's behavior, we adjust towards the peer. But then there's something that bothers me in a positive way, not a negative way. It raised my curiosity. Why is this asymmetry? Why I would curtail my consumption if I overspend and do not raise my consumption when I underspend? It forced me then to think about, wait a minute, maybe your anonymous peer is a bit too gross. There exists a variation about my expected future income that affect my behavior. When I think in this way, then I say, okay, maybe the peer's consumption convey information to me about the expected future income. And so if I overspend, it may be because I am too optimistic about my future income, so I cut back. Then why do I not adjust for my being too pessimistic about my future income and raise my consumption? So I just don't understand that part, and you raise my curiosity, and that's why I like the paper. Then it raised another point that I really wish that you could tell us more. Is there any switching from overconsumption to underconsumption? The switching in information may really reveal a lot of the learning or the feedback and all this thing. And also, if we, well, but you know what I mean by why I'm curious in the switching, and not to take up too much time, I should release the airtime. So I just hope that you can shed light on all this. Thank you. I better really give the time to other people.
Yi, would you want me to respond first or take more questions?
I think a lot of questions, so please go ahead.
Okay, so first of all, yeah, so who developed the app or who signs up? I mean, okay, so this app, the way status was introduced was initially, like, the name is a little bit strange, but what the name stands for is Stat Us. So how statistics can help us making better decision. That's what the founders had. And the idea was that they wanted to start with this peer benchmark. And then over time, after acquiring customers, the idea was to kind of provide more and more financial services always based on this peer benchmarking. For example, what they currently do is they'll show you what your APR is on your credit card, and then they'll show you that you may have better options for credit cards, or you may have that your mortgage maybe has a higher rate than other individuals that are similar to you, so they can kind of help you refinance it, and so on and so forth. And so initially it was, I mean, traditionally it was targeted to individuals that were looking for financial advice, but maybe did not have the wealth, enough wealth to kind of pay for a financial planner or a financial advisor. And in fact, after our sample ends, the company started introducing some hybrid kind of advice structure where you can now contact a human financial advisor or human planner within the platform that helps you making decisions. In terms of your idea that individuals tends towards the mean and the asymmetry. I mean, we have been kind of, and I think this is actually related to Tianyue's comment on kind of social learning, social utility. There are at least 5 or 6 different theories floating around that could be using that could be at play, you know, ranging from the visibility bias to wealth signaling to keeping up with the Jonases to present biases. And in many cases, what happens is that some of the standard, theory may not be able to explain this asymmetry. At some point, Michael, Francesco, and I were thinking that maybe what is at play is both this combination of peer pressure and peer information, while you basically have that the symmetric reaction would be kind of the pure information, and then you have that whenever you kind of fallen behind, then you have this extra peer pressure that comes into play. But I think that we were discussing with David Hirschleifer a couple of weeks back. He was arguing that also visibility bias can explain, like the standard theory visibility bias can explain this asymmetry. But I think going back to the what
how did it explain?
Well, the idea is that.
Mm-hmm.
The idea is that if you have a preference, I mean, if you're kind of observing only the conspicuous consumption and you just end up observing the true consumption, you're going to find yourself that on average, you're going to be over consuming. And so only those people that kind of already incorporate, that are extra sophisticated and incorporate already the fact that they observe the conspicuous consumption from other people, they may be the one that are going to be reacting less. That's roughly the kind of the mechanism, but we are basically kind of working towards this. I mean, unfortunately, we have that. It seems to be the case that
but only if I indulge in more conspicuous consumptions that I will revise downward, not like
exactly.
what you have.
Yeah. So basically, I mean, imagine you have a situation where you have some people that don't incorporate, that they don't realize that they live in a world where they only observe conspicuous consumption, and some instead have they are extra sophisticated. So the ones that are going to be over consuming are the ones that are less sophisticated, and they're going to be kind of reverting back because the other ones already have this piece of information. So this is kind of the asymmetry in reaction. But I think that deep down, it's very hard to have a off-the-shelf theory that explains all the findings. And so it kind of becomes interesting. At the same time, it raises a couple of puzzles. And that's why I think that we have been very we shy away from kind of drilling deep into the mechanism, exactly because it is challenging. It's difficult to distinguish among different theories. So a lot of theories could explain the results, but not perfectly. And so that's why we are a little bit in this kind of situation where we are kind of focusing on the facts.
Okay, Professor Xu.
Oh yeah, thank you very much, Yi. This wonderful paper. I have two thoughts. One follow up at Bernie, but I do have explanation that is, the majority of us people sign up are just normal people, but one group of them, one particular group, they are concerned about their overspending, so that's why they sign up. So your result, the kink of the asymmetric pattern may be driven by this particular group. They think they overspent and they got confirmation. So they realize, oh, we need to cut back spending. That's the first thought. And the second thought is, but this is a particular cultural thing. I wonder if the users were asked if they are expecting any inheritance or gift from their parents, right? Because I know that in the US, this is less a concern, but in Asia, guess what? Like all kids are expecting the inheritance from their parents. In Taiwan, I saw kids like spending money, spend all their income because they are expecting to inherit the part from their parents. All right. So housing is never an issue. So I just wonder whether users or whether the status like the app ask users this information, or you can recommend them to ask this.
I think it's a very good point, exactly because once again, considering the like when we thinking about the households and we actually like in household finance is very interesting. When we moved already from before we were doing household finance, when we really were thinking about individual decision making, and now we are kind of expanding household finance into the decision making of the husband and wives and maybe also the children. But I think going forward, I completely agree with you. I think that the full structure of the family and also the culture underlying the decision making makes a huge difference. I come from a country that is very similar. In Italy, we have that culturally we tend to have that inheritance are very big part of what is going to be the overall wealth of the individual, and also there is an expectation of taking care of the parents, which is very different from what happens in Anglo-Saxon countries, where you tend to be much more independent on both ends, right? When both of you leave the household, your family very young, but you also have that as you get older, you're much more independent. Let's put it that way. I completely agree. Unfortunately, we do not have. This is something that could be asked in a survey. This is something that we don't have in terms of information. But I agree with you. This could actually drive some of the kind of the behavior for sure. Yi?
Yes, Alberto and Francisco also online. So very fantastic paper. So follow up, echo the previous discussion in terms of reflection, in terms of seasonal adjustment of consumption spending, business cycle, calendar effect, in terms of intra-family bargaining, household bargaining. But my question is very simple. So maybe maybe you and Francisco can provide some insight. So how can we measure in terms of distance during digital age? Is distance by physical distance or by peer effect, peer group by same education, same risk group, or how to measure this kind of distance within during digital age, which something also part of me. And we know all the discussion of home bias, all these different issues of peers by office mates, classmates, alumni, but how to do this kind of online. So that's something I think previous discussion already asked a great question, also reflect my reflection also question. Mainly this thing, how to compare, how to measure, or how to think deeper in terms of distance. We all have different patterns. Thank you.
Yeah, so I mean, you're thinking about distance from peers, right? So what do you define? Yeah, so in our case, we actually exploiting the feature of the app. So the app is designed in such a way that you have a constraint. So the app is designed in such a way that the peer group needs to have 5,000 individuals at the minimum. And so, of course, what happens is that if you're living in an area that is densely populated, for example, then the app will be able to match on all the characteristics, right? So they'll match on your income, on your age, on your credit score, on your city, and so on and so forth. On the other hand, if you're in an area that is not as densely populated, then the app will not use 5 characteristics or 6 characteristics, but it's going to go down and use less and less characteristics. So from our perspective, then we have a very natural way of using kind of determining what the distance from peer is, which is nothing else but how many characteristics you're matched on individuals that are similar to you. Of course, there is you can use very different ways, and then of course we have in the paper we are pretty open to having different measures, but this is the most natural to us that was coming from our setting. Of course, I think that you raise a very different. You raise a deeper point, right? So what are peers and what are not peers? Unfortunately, and this is actually kind of an interesting project that we would want to follow on is exactly trying to exploit apps that potentially allow individuals to select their peer groups, so endogenously choose what their peer group is, because by then you can start understanding what is a peer group. So it may be that for me a peer is someone that has the same job as me and live in the same city as me, but it may be that for me a peer is my high school friends, right? So for me, it may be that I'm still stuck in the past. So there is, I think that we have a ton to learn. And, like now, after showing that these peer effects are potentially useful, I think that there is a lot that we can do in trying to understand exactly what people perceive as peers and how people endogenously choose their peers. And on the basis of this peer selection, we can have that some of these tools can be much stronger in terms of guiding people's consumption behavior.
Great. So Bonnie, yes.
Yeah, I have 2 things. One is that the peers influencing our behavior is a very powerful proposition. In Singapore, like people like Sumit Agarwal will say a lot about household sustainability, and I wonder if you can track people's utility spending. In New York, you receive your bill. In Singapore, the same, and what your peers, your neighborhood people spend. And when you see that, is there any feedback effect in your consumption of water, electricities, and so on and so forth? That would be an interesting thing to look at. The second thing is that I don't know how refined your data set is. When we talk about the distance and so on, who are really our peer, in a way it's about like, if I'm an old man, my peer, and this collection of peers is younger than me, then there would be a distance, right? And I think it would be, I don't know whether you have information on the race, on the age, and marital status, etc., etc. If you have that, it would be wonderful. If you don't, there's one way to deal with it. Like if you go to New York City, you know where the Chinese are living. They're in the Chinatown area, etc., etc. So you can go to that area and find out whether they under or overspend and how do they adjust their spending afterwards. So there may be some way to, in a rough manner, to tease out the further subdivisions effect on reading your data's results.
Mm-hmm. Absolutely. I think, Bernie, these are fantastic suggestions. I think, yeah, so we have some information like age and so on and so forth, but we don't have a super detailed the kind of a set of information. That's why also I didn't have too much time to talk about the randomized control trial, but exactly, I mean, there are some effects that come into play. For example, whether you have kids or what is your marital status. In that kind of context, your constraints are going to be determining dramatically what is your ability to adjust your spending. And so we actually show that the results are kind of very consistent across all these demographic characteristics that we do not observe. But I agree completely with you that we can definitely do more along this dimension.
Yeah. Francesco is typing an answer. Do you see that?
Yes,
yeah.
Yeah, there's a question from Tianyue Hong Kong student, and I think his question is, do you see the peer group bucket to change in time to time? For example, I belong to a group for 100K below today, but to group 100K up to 6 months later. It will be interesting to look at how behavior change when peer group change as my anchor group will also change. Yeah.
Yeah, so this is a kind of a very interesting. No, so I mean, the peer groups gets assigned to you the moment you sign up, and then I mean, Tianyue was mentioning. So this kind of peer groups are, and the consumption of these individuals are computed at a given point in time, which actually is potentially less powerful from an app kind of perspective, but it's actually better from a design of our test, because that kind of number, I mean, if anything, we would love to have that people are given random numbers regarding the consumption of others, right? But I think that going back to what Bernie was asking, and I think this is a very good point, one thing that may happen is that you may overspending on the first month, but as you start decline, you may be underspending. And so seeing exactly what is that, like I showed you what happened to the path of consumption over the 12 months for those people that decrease, and we can show that those decrease, they kind of converge around 37% compared to their peers, but we could actually focus on the ones that just barely overspending and then they go down and see how they fluctuate around their peer group consumption, because that could be a very interesting kind of exactly way to show that it's really the peer effect, that if people were dancing around that peer consumption, this would be a very strong kind of a result showing that the peers is what they're anchoring at.
Any other questions? Otherwise, we almost came to the good end. And thank you very much. It's very late in DC right now for Alberto. So maybe Bernie make some final remarks for next.
I just want to thank Yi. Really, thanks for sharing this, and Alberto and Tianyue, and also Francisco. I greatly, and I think that others feel the same, enjoy this learning experience. And so thank you very much. And I would also like to draw your attention to that we owed a thank you to Polek, Alberto's co-author. He was the one who get our attention to this wonderful piece of work. And thank you. I'll write to him, to Polek. And then our next one will be on January 11th, the supply and demand for data privacy evidence from mobile app. And the presenter would be Twin will be Wong Tang from LSE, and the discussions is likely. Can we confirm the discussion, Yuan?
Not yet. So we're going to
Okay.
next week.
Okay. So we'll work on that. And I look forward to seeing you all again on January 11th. And thanks a lot for everyone's support. And thank you, author. Thank you, presenter, discussions, and chair. Thank you. And thank you to Bolek.
Happy
Thank
holidays.
you.